as you rightly pointed out, if the bond yields start to climb higher, your equity risk premium then comes into play. And that means that it has a very, very negative impact. It could potentially have a very negative impact on the equity markets.
Yeah.
And then volatility is going to pick up. So that's what we're most concerned about.
What's the threshold? 5, or is it even lower than that? 4,
I think it's even lower than that. I think anywhere above 4.6 is probably going to bring...
And we get a 10% correction? Or even more?
Not really. Because, okay, the other mitigating factor is that your corporate results have actually this far been pretty okay, right? And so, in that sense, you're sort of like mitigated to a certain extent. But the problem is that the Federal Reserve will continue to cut. So that in turn is also likely to neutralize some of the impact at this point in time. Because don't forget that the Federal Reserve...
will continue to cut?
Absolutely, because inflation is still trending down at this point in time. Inflation will only pick up 3 to 6 months after the tariffs come in. It won't pick up immediately. The Fed is data dependent.
So how much time does the Fed have then? How many cuts can they sneak in?
So we think there'll be 4, but arguably the last cut that we think that's going to happen in the 4th quarter of next year, there's a big question mark right now. So we do think that, we believe that the Fed will continue to cut in December, 1st quarter of next year, 2nd quarter of next year, and potentially in the 3rd quarter of next year. But the 4th potential cut in the 4th quarter of 2025, there's a big question mark there, because by then the tariffs would have actually transmitted in through the economy itself.
How worried should we be about Europe? And the transmission mechanism is clearly a softer euro, and that feeds into higher DXY levels.
I think Europe is the biggest net user.
And that becomes a problem for us.
Absolutely, yeah. This is probably the worst probably the worst scenario possible for the Europeans, right? Because of the fact that, if President-elect Donald Trump shifts the financing burden of the Russia-Ukraine war to the Europeans in order to force or compel them to sort of try to come to a peace settlement.
They don't have the money.
They don't have the means. They'll have to issue bonds. And you're not going to be issuing on a 1-year, 3-year, 5-year basis. You're issuing pretty long-term bonds, right?
So their yields go up as well.
Absolutely. You're issuing at close to 3%, but the economy is growing at 0.5 to 1%. So there is a gap of 2.5% that needs to be funded. Right? And it compounds. And as we said, these are long-term duration bonds, right? So it compounds and it grows. At the same time, you have the traditional powerhouse of Germany slowing down dramatically, political uncertainty. You have elections next year. And, with the way the German political system is structured, you get a coalition government.
It sounds like to me you're saying, it's going to take some time, take a while, but we are probably looking at a recession in the U.S. and Europe.
I think that's the longer term. For the US, it's more of a longer term play. But I think for Europe, it might come earlier than expected.
Earlier?
Absolutely, yeah. That's what we think is going to happen. Growth outlook there for Germany is certainly not so positive. And, as we were discussing, the political outlook is also very uncertain, right? They are likely to have elections in February next year. And the way it is structured, it will end up with a coalition government again. And if it's a coalition government, nothing gets done. So I don't see any I don't see any daylight on a short-term basis for
if you are exposed if you have own a fund that's exposed to Europe, do we grit our teeth, stay invested, and hope for better times, or do we lighten up, selectively reduce exposure there?
I would reduce exposure to as much as I can. On a bottom-up basis, you probably want to have some exposure to the pharmaceuticals, to some of the luxury stocks, right? In the event that, the big awaited stimulus from China kicks in, and that actually helps that. But other than that, it's very, very hard to find anything else compelling to buy in Europe.